Welcome to the deep dive. Today, we're really digging into the whirlwind around Opendoor Technologies. That's ticker symbol OPEN.
Yeah, it's been pretty incredible to watch.
Absolutely. I mean, a stock rallying 50% in just the past week, and something like, what, 315% this year, hitting a three-year high. It's definitely got people talking.
For sure. There's a lot of buzz.
So our mission today is basically to unpack this. We want to look at Opendoor, this real estate tech company. We'll explore their iBuyer model, what they actually do.
Right, the core business.
Exactly. And then dive into the recent leadership changes, fueling all this excitement, but also critically look at the criticisms, the
Yeah,
challenges.
the other side of the coin.
Yeah. Ultimately, we want to give you a clear, rounded picture of what this all means for Opendoor's future. And, the big question, just
Yeah.
how high can Opendoor really go?
And we've looked at quite a bit, financial reports, analyst ratings, market chatter, articles on their model, competitors, all that stuff.
Great. So let's start at the beginning. Before the stock went completely wild, what is Opendoor? What's this iBuyer model they sort of pioneered?
Well, Opendoor's vision, right from the start, was about creating a uh, radically simplified experience for home selling and buying.
Simplified how?
Basically stripping away the usual hassles, making it faster, more convenient, more transparent, and, they'd argue, more affordable.
Okay, so for someone selling their house, what does that actually look like?
It's designed for speed, really. You go online, tell them about your home, instantly you get an estimated value, it's free, no obligation.
Okay.
Then there's a virtual assessment. After that, you get an option. Sell directly to Opendoor for cash, right then and there, or you could list with one of their agents instead.
Right, so that cash offer is the iBuyer part. Speed, certainty, sounds appealing. But, I mean, how do they make that work financially? What's the catch for the seller?
Yeah, the financials. That's key. They charge a service charge. Typically, it's between, say, 5 to 8% of the sale price.
Which is kind of similar to traditional agent commissions, maybe a bit higher sometimes.
Sometimes, yeah. Traditional commissions are often around 5–6%, split between agents. But Opendoor's fee covers more than just the transaction. It helps pay for things like maintenance on the house while they own it, utilities, property taxes.
All the holding costs.
Exactly. And crucially, Opendoor takes on the risk of owning that home until they resell it. That's a big piece of what that fee covers. They absorb the market fluctuation risk.
So you pay that fee, but you skip a lot of headaches. They give you cash, you pick your move-out date, they handle repairs after you leave.
Right, and they say they pass along wholesale discounts on those repairs. Plus, a really important point, sellers can walk away anytime before closing. No penalty.
That's a big differentiator. So if you need to move fast, maybe for a job or you're juggling two mortgages, that convenience factor is huge.
It really is. Yeah. And that ability to back out is key compared to some others. Their offers, they're based on a pretty complex data model, analyzes tons of recent sales, plus they get input from local real estate experts, trying to hit a fair market value.
Okay, so that's the selling side. What happens after Opendoor buys the house? How do they handle the buying side for the next person?
Once they own it, they maintain it, fix anything necessary, and then list it for sale. For buyers, they push flexibility. You can browse listings on their app, tour homes pretty much anytime between 6 a.m. and 9 p.m. daily.
No appointment needed.
Nope, just use the app. And you can choose to buy straight from Opendoor, or bring your own agent, or use their support. Again, the idea is making it feel easier, more transparent.
Skipping the traditional selling hassle, it's easy to see the appeal. But how are those offers perceived? I mean, were sellers actually getting a good price, especially early on?
Well, perceptions have shifted. Back at their peak, maybe 2021, there were reports Opendoor was paying on average something like 107.7% of market value.
Wow, over market value.
Yeah, that built a reputation for really competitive offers. Combined with the convenience, that was a powerful mix.
Okay, so that sets the stage for the business model. But let's get back to the stock. It's been absolutely captivating lately. What's behind this massive run-up?
Right, the 315% year to date, nearly 50% in just a week recently, hitting that 3-year high.
Insane numbers.
It seems to be a convergence of things.
Yeah.
You got activist investor Eric Jackson really making noise, pushing for changes.
An activist investor, meaning someone buying up stock to force the company's hand on strategy or management?
Exactly. And then there's the whole meme stock angle. It's caught the attention of retail traders, individual investors often coordinating on social media, which can drive rapid, sometimes speculative, price surges.
Ah, the meme stock effect.
Plus, you can't ignore the broader economy. Macro factors are definitely playing a part here, too.
And speaking of changes, there's a big one at the top right, a CEO departure. That seems tied into all this investor excitement.
Absolutely huge. The CEO, Kerry Wheeler, left effective August 15th, 2025. The company said it wasn't over disagreements on operations, but it definitely came as pressure was mounting.
Pressure from?
From activist investors like Eric Jackson, who'd been pushing for governance changes since July. And from retail investors, too. Co-founder Keith Rabois even publicly called Wheeler utterly incompetent. Pretty strong
Oh,
words.
wow. Yeah.
And Jackson reportedly threatened a shareholder lawsuit if Rabois wasn't involved in finding the next CEO. So, serious pressure.
Okay, so who's running the show now, even temporarily? And what's the new direction they're signaling? Because that seems key to the stock search.
Right. The board appointed Srisha Radhakrishna as president and interim principal executive officer. He was the chief technology and product officer since late 2024. Eric Fenner also stepped up as lead independent director.
And the strategy shift.
Well, interestingly, the announcement about Wheeler leaving really leaned into an AI-powered pivot. They said Opendoor is, quote, well-positioned to focus on its considerable data and unique assets in today's high-tech AI world.
An AI pivot. So tying the leadership change directly to a new tech focus, even if the specifics are maybe still emerging.
Precisely. That narrative, new leadership, AI focus is definitely part of the current bullish story driving the stock.
Were there other sort of market-level things happening that helped fuel this beyond the company specifics?
Yeah, definitely. There was that weak August jobs report, only 22,000 non-farm jobs added, way below the 75,000 estimate. Plus, June's numbers got revised down to show a contraction.
Okay, and how does a weak jobs report help Opendoor?
It strengthened the argument for the Federal Reserve to potentially cut interest rates. Lower rates could be a big deal for Opendoor.
How so?
Two main ways. It could let them refinance their debt on better terms, easing cash flow pressure, and, more broadly, lower mortgage rates generally create a better environment for the housing market, which is, their core business.
Makes sense. Easier borrowing, maybe more transactions.
Right. And connecting this back, the timing of a CEO change, especially with a strategic pivot like AI, can really move markets. There's research actually from Oxford University.
Oh, yeah.
Yeah, it shows a new CEO outlining their strategy early on, like in the first 100 days, can boost stock prices by an average of over 5%. Even more if they're an external hire. Think about Alibaba's Daniel Zhang. His Go Global strategy announcement gave the stock a big lift. Contrast that with, say, Twitter's Jack Dorsey admitting he didn't have a strategy, billions wiped off the value.
So that communication, that vision is critical during a transition.
Hugely important.
Yeah.
It really puts the spotlight on Opendoor's next leader. Can they deliver on this AI pivot? Can they provide that clear strategic vision?
Yeah.
And ultimately, how high does that vision allow Opendoor to go?
Right. So, okay, we've got the bull pace. New leadership, AI buzz, potential macro tailwinds, huge stock momentum. But we need to look at the other side. What are the fundamental challenges? What are the bears saying? How do they stack up competitively?
Well, first off, the overall analyst consensus is just hold. Based on 22 analysts, it's a real mix of buy, hold, and sell ratings. Not exactly a ringing endorsement across the board.
A mixed bag.
Yeah. And then you had Citron Research come out swinging on September 5th, 2025. They're known for their pointed critiques.
What does Citron say?
They basically called Opendoor nothing more than a stock promo and a science project in how to burn money. Pretty harsh.
Ouch. What was their reasoning? What are the core worries?
Citron hit on several points. They questioned Opendoor's actual ability to use AI effectively to boost margins or even just defend their market share. They hammered on the fact that housing is just inherently a low-margin business. A small swing, 1 or 2%, can wipe out profit.
Yeah, the margins are tight.
Very tight. And the model is super capital intensive. You need billions tied up in houses you hope to resell. No guarantees. That ties up huge amounts of cash. Citron also warned about ongoing cash burn leading to potential shareholder dilution, meaning issuing more stock, which can lower the value of existing shares.
Dilution is always a concern for growth companies burning cash.
Exactly. Citron's conclusion was brutal. Business model is not broken. It has never worked. They're basically saying the fundamental concept is flawed.
That's a direct challenge to the whole iBuyer premise and that AI pivot narrative. It also brings us back to the seller value proposition. If the model is so tough, how much are sellers really getting?
That's a crucial question, especially given that earlier perception of high offers. More recent data paints a different picture. An analysis looked at over 500 properties Opendoor and a competitor, OfferPad, bought and sold between May 2023 and June 2025.
And the findings?
It found Opendoor paid, on average, almost 8.8% less for homes than what they later resold them for.
8.8% less before fees.
Before fees. That translated to roughly $26,376 in potentially lost profit for the average seller in that study. And that's before you even factor in Opendoor's service charge and any deductions for repairs.
Wow. So the convenience factor comes at a potentially very steep price, tens of thousands of dollars potentially left on the table.
It really highlights the trade-off starkly. Sellers might not realize the full extent of that gap.
And this difficult environment brings up the competition. We've seen other big iBuyers stumble, right?
We have. It's a serious cautionary tale. Zillow offers, Redfin now, both major players shut down their iBuying operations. Zillow lost over $420 million. They admitted their model was flawed.
$420 million loss. That definitely underscores the risks here.
For sure. Shows how hard it is to make this work at scale, consistently. And remember, Opendoor is also pretty picky about the homes they buy single-family, certain townhomes, condos built after 1930, specific price range, $100K, $600, no major issues. They don't buy everything.
Right. So if Opendoor might not offer top dollar, has strict criteria, and charges fees, what are the alternatives if you're selling?
There are quite a few depending on your priority.
Mm-hmm.
Other iBuyers exist, like OfferPad. They charge an 8% fee, but might offer perks like a free local move. Then there are buy-before-you-sell services, like Orchard or Knock. They help you unlock equity to buy your next home before selling your current one. But they come with extra fees, too.
For people needing that bridge financing.
Exactly. If your house is in rough shape or you need cash really fast, there are those we buy houses for cash companies.
Right.
But they typically offer much less, maybe 70% of the home's after-repair value. Speed costs you a lot there.
A significant discount.
Definitely. And then, of course, there's the traditional wait list with a real estate agent. Generally, you'll net more money, but it takes more time, more hassle, and you have the standard agent commissions.
So different paths, different trade-offs between speed, price, and convenience.
Absolutely. And it all leads back to that fundamental question about the iBuyer model itself. Is it sustainable long-term, especially when the housing market gets choppy? Opendoor is capital intensive. They've had negative free cash flow, significant debt, consistently losing money.
That's the core challenge.
Right. Accurately pricing homes consistently, managing that inventory risk, justifying the fees versus the open market price, it's tough.
Yeah.
And it's central to figuring out, how high Opendoor can really go in the long run.
Okay, so summing this up, Opendoor Technologies is really at this fascinating, dynamic crossroads. You've got this powerful narrative. On one side, the surging stock, almost like a meme stock fueled by activists, new leadership, this pivot towards AI, maybe working more with agents. The excitement's definitely there.
Palpable, yeah.
Mm-hmm.
Retail traders are engaged. The charts look impressive recently.
But then on the other side, you have these really serious fundamental questions. Is the iBuyer model itself viable long-term? What's the real value for sellers versus the convenience costs? And we have the history, major competitors flaming out after huge losses.
It's a stark reminder of just how hard it is to buy and sell actual houses at scale, profitably. The logistics, the capital, the market risk.
Yeah.
It's immense.
So, as you, our listeners, think about the future of real estate tech, these direct-to-consumer models, what really stands out in Opendoor's story, it feels like this classic tension. Ambitious innovation trying to revolutionize a huge industry, clashing with some pretty harsh economic realities.
Yeah, innovation versus fundamentals.
Exactly. So given these completely opposing views, the bullish hype around the new strategy and leadership versus the deep skepticism about the core business, what wins out, will Opendoor's future be shaped by its tech, its AI pivot, maybe favorable market shifts, or will the sheer difficulty and low margins of flipping houses at scale ultimately prove Citron right? What will truly decide how high Opendoor can go?